Good morning. This is Mark Boud of Real Estate Economics. Thank you for joining us for our weekly webinar series. This morning we're offering some information on the housing market and the economy, as well as our 5-year forecasts for both for the Phoenix, Arizona metropolitan statistical area. And as we usually do, we like to give an overview as to where the overall housing market is in a given MSA. In the case of the Phoenix housing market, you can see that 32% of all transactions are associated with foreclosure sales. Those are homes that are being sold by the lender to a new owner. They're taking it out of distressed inventory, which is actually a good sign. It's a sign of cleaning up the distress, or reducing the overall inventory. However, foreclosures, properties being lost to the lender, represent 33.2% of all transactions. That's actually higher than foreclosure sales. Which means that on a net basis, overall distressed inventory is still increasing in Phoenix. That's a bad sign. And what it means is that there will continue to be some downward pressure on pricing in many areas of Phoenix. And you'll see our forecast for this year as well as the next 5 years in the next few slides. New housing builder transactions have fallen to 2.1%. It's an all-time low in this market. You'll see in just a bit what a more normal market atmosphere looks like. And then traditional resales represent 32.6%, also extremely low for this market. To give you an idea as to what a more normalized market looks like, in 2006, new home builder closings represented 35% of all transactions. Resales represented 60%. Those shares are much more normal, and then overall transactions or distressed inventory transactions were less than 5%, which is also typical of a more normal market and more normal economic times. Unfortunately, we're not feeling that yet. Over time, we'll migrate toward that, but it will take years to replace the existing conditions with this more normal atmosphere. In terms of what's going on in price and price per square foot, here are the 24-month trends during the most recent month for which we have data. The overall average price per square foot was $97.54 per square foot. That's a little bit less than it was a year ago, reflecting the formation of a bottom, or kind of bumping along the bottom of a price floor in this market. We continue to bump along that floor. Overall, absolute prices have actually increased somewhat, more reflective of where transactions are occurring as opposed to appreciation. Both the most recent data and 12 months ago, both of those averages are less than where we were 24 months ago. So this market, unfortunately, is still in some degradation. We think that there is a floor that has formed or is forming, but will probably continue to bump along this floor for at least another 12 months or throughout year 2011. In terms of where transactions are occurring by type, the blue bars that you see are transactions of traditional resales. As you can see, resales have remained fairly constant during the past 12 months. Foreclosures, shown in red, have actually increased, as have foreclosure sales. However, in February of 2011, as well as 12 months ago, as well as 24 months ago, foreclosures continued to exceed foreclosure sales, which means that overall distressed inventory is increasing. And you can see the continued degradation that we face in the new home market as fewer and fewer new homes are being built because of very restricted construction lending as well as weak demand. Looking at distress a little bit more, we track notices of default, foreclosures, and foreclosure sales. And over time, as you accumulate the difference between foreclosures and foreclosure sales, it gives you a very good idea as to how much distressed inventory is actually still being held by the lenders. And this is a depiction of that. This target has been moving around a bit as we've become more effective in identifying distressed inventory. Our numbers have changed, but the patterns have remained about the same, which is that we peaked in year 2008. We saw a big drop in distressed inventory in year 2009 as very strong values brought out some speculators and investors and brought down that inventory. But during this past year, from 2009 to 2010, we saw an increase in overall inventory. That's that reflection of foreclosures continuing to exceed foreclosure sales. Unfortunately, that's continued during the first 2 months of this year, but we think that that reverses soon. We think that the recent job growth that we're seeing begins to, or combines with extreme values in this market area to increase demand, a lot of that distressed inventory begins to move at a faster rate than it is being thrown into the market. So the overall peak, we think, the most recent peak was in 2010. We don't think 2011 will match 2010. There'll be a reduction, but there'll still be an enormous amount of distressed inventory for the next few years in this particular market. How that impacts overall construction. Here you see the annual levels of housing construction, and you can see right now that it's really at an all-time low, but if you add distressed inventory to that, which this chart does, it's not quite as low as it would otherwise be with just construction alone. However, it continues to decrease during the next few years. Year 2014, despite the fact that we'll be building more new homes, we'll also be seeing a net burn-off of distressed inventory. So overall supply levels, new home construction plus distressed inventory, we think falls during the next 4 years. Not until year 2015 will we see an increase, and that increase will still result in a very, very low year of supply. So the scenario is, as time goes on, demand will increase based upon economic expansion that we're just beginning to see. And as it increases, not much will be out there for demand to meet demand, which means that 2013, 2014, especially 2014, 2015 ought to be very healthy years in this market due to a lack of supply and increasing demand. So turning over to those factors that generate housing demand, obviously the main one is economic growth. And you can see our forecast for year 2011 total jobs is slightly higher than 2010. In fact, we're already beginning to see increases in jobs that began in January of year 2011. Here's our 12-month forecast on year-over-year job growth. We think that it gradually continues to grow throughout year 2011 into 2012. To give you an idea as to where we are right now in terms of job growth, most of that growth is occurring in leisure and hospitality, in education and health services, and in trade, transportation, and utilities, also with some growth in manufacturing. These are the initial drivers. We think that begins to expand this year into information, professional business services, even financial activities we think turn positive this year. This is not the most healthy of job reports, but it's far more healthy than where we were a year ago, which is what this particular slide depicts. So we certainly are not recovered, but we're heading in the right direction. In terms of annual growth, we think that this year the overall net impact annualized growth will be over 15,000 jobs, certainly lower than historic norms, but it will increase from there. And we think that by 2015, as we continue to build on a normal economic cycle, we'll be pushing about 91,000 jobs in that year. That creates demand for a lot of homes. It also will take time, however, to fill the enormous hole that we dug in terms of job losses in 2008, 2009, and 2010. All of this information translates into a model which depicts housing demand, shown by the blue curve, as well as housing supply, shown by the green curve. This particular chart shows the differences between the demand curve and the supply curve in the previous chart. As you can see, we are in a period of enormous oversupply right now. We're eating into that, and eventually we will hit equilibrium again, but we don't think that happens until about 2014, though you will feel some market tightness forming in 2013. And thereafter, we think that a very, very healthy cycle of undersupply occurs, which begins to push up pricing again. To give you an idea as to where we are in terms of price, this is the other half of the model, which depicts supportable median prices relative to household incomes, which is shown by the green curve, relative to where prices have actually been or where we think they are going, and that's shown by the blue curve, which depicts median home prices by year. You can see the enormous overvaluation bubble that formed in 2004, 5, 6, 7, collapsed hard in 7 and 8, and in fact it corrected at the same time that we were reducing mortgage rates and prices were falling, creating increased affordability. And so the overall gap between what we can afford and where prices were increased dramatically and continued at a very wide level. This particular chart depicts that either overvaluation or undervaluation from the equilibrium line. You can see the enormous overvaluation that was apparent in 2006, 2007. That's the bubble. It collapsed hard and overcorrected to a point where we are extremely undervalued now. The point with this particular chart is that almost as unstable as we were in 2006 and 2007, we're almost as unstable as that right now. It's just the flip side of that equation. This must be forced back to equilibrium over time, and the way it's forced back to equilibrium is by an increase in mortgage rates or increases in price or a combination of the two. And as demand increases and the economy begins a new cycle and begins to expand again, which it's just beginning to do, we think that pressure in terms of forcing prices and rates to equilibrium will occur. That'll take years though, and in the meantime, it has never been, housing has never been a stronger value in Phoenix. And we think that as the economy begins to grow and increases consumer confidence, that leads to very healthy market conditions. It will take quite some time for that to become fully established. We think that year 2011 is a stabilizing year, but it's not necessarily a healthy year in the market. It's not till 2012 and beyond that we see that health, and I'll show you the index that shows that. Here's our overall forecast for median price changes. It's our best proxy for appreciation, and notice that we actually show a slight decline in price during year 2011. That's mainly due to the impact of enormous amounts of distressed inventory, as well as the fact that the economy is growing, but we're still suffering the ramifications of losing so many jobs. This graphically shows the overall level of absolute price. Even with our price appreciation forecast, you can see that by 2015 prices are nowhere near where they were in 2005, 2006, 2007, when they were so artificially inflated by demand that was really never meant to be in the system. So we are forecasting appreciation, but it does not bring the medians up to previous high water marks. Here are the overall patterns in terms of underbuilding and overbuilding relative to undervaluation and overvaluation. And if you combine those two, you can see in the far right-hand charts or columns, there is an opportunity risk index. That index really depicts how the market is going to perform. Usually it leads the market by about 24 months. I think for this particular recession, that lead time will be lengthened because of the severity of the recession, which means that the strong index that we felt in 2009 really manifests itself probably in 2012, perhaps the latter part of year 2011, which spells a strong 2012, not necessarily because of a very strong economy. It's mainly because of the realization of incredible values as the economy is growing. We think that that first impacts the market in terms of strong market conditions in 2012, and then builds thereafter as an increasing economy combines with strong values to bring about healthy price appreciation and a normalization of overall market conditions. We don't ever think we'll see those enormous booms that we saw in 2005, 2006, 2007, because those were really artificial. We think that regulation that is being put in place will prevent that from happening again. That is our webinar for this morning. Thank you very much for joining us. Those of you who are interested in our consulting services, please feel free to contact myself or my associate John Mulville. Those of you who would like to explore our web-based information tools, feel free to contact Judy Duell or Sandy Rivero. Thank you very much. Take care.